Before we start the webinar, we'd like to introduce NJCPA Launchpad, our new accounting internship search site. Upload your resume and search for opportunities at launchpad.njcpa.org. And now, here's today's webinar.
Hi everyone, thank you for joining this webinar. My name is Zack Cohen. I am a Senior Internal Auditor at Prudential Financial. I'm joined here with Melissa Dardani from Baker Tilly, and we're here to talk to you about student loans and other financial management tips based on our personal experiences as well as our role within the society as emerging leaders in the Emerging Leaders Council as well as members of the Student Loan Task Force. We thought it would be a good idea to host this webinar for prospective college students to talk about different types of student loans, some experiences that we've faced, and tips that we thought would be a good idea for everyone to consider as they go through their college application process. Just to give a quick high-level summary of my experiences, I attended a private college in Pennsylvania for 4 years. Most of the cost of that education was split either between scholarships or student loans. By the time I graduated in 4 years, I've accrued approximately $60,000 in student loans, which after 8 or so years after graduating, I'm still in the process of paying off. So this is something that is very near and dear to my heart. But I think going through all this information as we talk through the agenda and all the content, I think this is a great topic to discuss and consider. So I'll hand it off to Melissa so she can talk about her experiences with her student loans and her past experience as well.
Sure. Thanks, Zach, and thank you everyone who's taking the time out of their day to attend this webinar. I would echo what Zach said, that really the best thing you can be doing for yourself is educating yourself as to your options and really understanding what it is that you're signing yourself up for. It's kind of the course that one follows. You graduate high school and you go to college, and we do so because financing is so easy to attain. We do so without really thinking about what it is going to cost us in the end, and we have some good examples that we're going to go through with you today that will really kind of highlight and speak to that point. Myself personally, similar to Zach, I attended a private institution in New Jersey. By the time I walked out with my undergraduate and graduate degree, I had accumulated about $180,000 of student loan debt. It was, and part of that was accruing interest during the time that I was in school. So not only did I have the principal balance included in there, but also a lot of accrued interest, which was now accruing interest on top of it. So it was just really an unmanageable burden. I was fortunate enough to get a great job in public accounting, but even so, it worked out to be about 50% of my paycheck, or every paycheck right off the bat, that was going towards this unbearable student loan payment. So with that in mind, I've kind of, through my involvement with the society and through what Zach and I have been working on, we've been able to put this program together for you to try and help some tricks of the trade, high-level takeaways that you can put into practice as you're navigating these issues yourself. So with that, let's jump into the agenda. So we'll start out by introducing the student loan landscape, again, from a very high level, just so you can get an understanding of what it looks like across the nation. You are not alone in this. We'll give you some statistics that will kind of lay that out for you. We are obviously coming up on an election year, and I think it's important that we talk about what the candidates from both sides, the Democrats and the Republicans, are saying about student loans, what they're proposing and what they're kind of touting on their platform. We will also talk about the different types of loans, the different financing options, alternatives to loans, if you're able to take advantage of some programs or scholarships, grants, ways to deter having to take out the debt. Again, understanding what programs may or may not be available to you federally or New Jersey State, how the student loans can affect you once you graduate from college and what kind of impact this can really have on your financial future. And we'll wrap it up with just some tips as to what you can be doing to educate yourself, protect yourself, and make sure that you get the education that you deserve, but at the cost, at as least of cost to you as possible.
So I'll kick it off and start going over a high level as to the student loan landscape and just going over some facts, both federally, specific to the state of New Jersey, as well as considering other countries abroad and how student loan affects borrowers within those respective countries. So just to give a high-level number, as of right now, mid-October of 2019, we're around $1.6 trillion in total debt outstanding within the United States. That's broken out into a federal balance and a private balance. The federal balance is a little more than 90% at $1.4 trillion. The private balance, those from private lenders, for example, Navigant, My Great Lakes, Fannie Mae and Freddie Mac, represent approximately $120 billion of that balance. If we go a little more specific into the state of New Jersey, from that $1.6 trillion balance, we're actually the 12th highest state within the nation with student loan debt, and that comes in at around $37.6 billion. So just a little bit under 38 as of this past year. In terms of default rates, meaning borrowers that haven't been making active payments on their loans in approximately 360 days, the number across the nation on average is a little under 11%, and for New Jersey, we're just a little bit under that average, which is it's a good sign, but it's not great, but we're just under 10% in terms of default rates. So hopefully as we go through our presentation here in terms of explaining the different types of student loans, the different options to consider, tips and tricks that you can take either while you're in college or as you're planning to attend college, hopefully with enough communication to a larger audience, hopefully these default rates can go down over time. So speaking in terms of the student loan debt balance across different countries, the average balance for the United States is a little bit over $37,000, so approximately $37,135. For New Jersey, that average number is just a little bit above $33,000. But when you take into account different countries throughout the globe, most notably the United Kingdom, Canada and Australia, and then finally Germany, we are actually above those numbers for those respective countries. You see the UK comes in at approximately $31,000 per graduate. For Canada and Australia, they're around the same, approximately $20,000. And then Germany is an outlier when compared to other student loan countries with student loans with respect to student loan debt at approximately $2,400. And the reason why Germany is so low compared to other countries is because public universities within that country are free. So for people enrolled in German schools that are paying off these loans, these are for private institutions specifically. And then finally, one other fact I wanted to highlight at the end of this slide, a Georgetown study actually back in 2013, so just about 6 years ago, had a study and came out with a very interesting metric that I wanted to put out here, and it definitely echoes Melissa's statement at the beginning of the presentation, where by 2020, so coming up within the year, 65% of all jobs those that employers require will have some level of post-secondary education as the base requirement for an entry-level job. And that's up 28% since 1973. So definitely this theme of be doing well in school, going to college, and getting a job, that story is definitely set in a very strong foundation, and it's a very strong requirement. It's something that we were told as we were younger and going into school, and definitely now it definitely sounds like this is something that is still the theme, that you have to go to school in order to get a good job and to have that financial wellness and that financial independence later on in your life. So hopefully with these tips, as we go through the rest of the presentation, hopefully that level of financial independence could be easier achieved.
And I guess one other thing to echo what Zach was saying, when we look at this statistic about the 65% of all jobs requiring post-secondary education, one potentially petrifying consideration is that we're also in the age of technology, and how many entry-level jobs are actually going to be replaced with some sort of automation process, as we move through the next decade or so. When you put those stats side by side, I think it can probably be pretty overwhelming, considering how much emphasis we put on post-secondary education. So that being said, we're going to dive into what some of the political hopefuls for the 2020 election are saying on their platforms. And we have kind of a sliding scale here, particularly as it pertains to this issue. I won't classify politicians by one issue alone, but when we look at the student loan and education issue as a whole, we kind of have a scale in terms of how progressive the candidates are. So if we look at, we'll start with Elizabeth Warren. Her plan is to attempt to cancel a lot of the outstanding debt. The statistic that she's thrown out there as a part of her plan is that she would like to cancel 95% she wants to cancel the debt, some level of debt, for 95% of borrowers. And for 75% of borrowers, she would like to completely eliminate their balances of debt. It would work on a sliding scale, so it would be dependent on your income, which for most first-year out-of-school graduates don't have to worry about having tremendously high incomes where they would get phased out of her plan. But what she has essentially proposed is for graduates with household income under $100,000, she would like to cancel $50,000 of their debt. And that gets phased out on a sliding scale to $250,000. So at $250,000 of household income, you're completely phased out, and it's a $1. It's a $1 phase out for every $3 of income, which would ultimately, once you get to the $250,000, you'd be, no elimination would be allowed. And the way that she plans to fund this is with a 2% tax on net worth over $50 million. She has called it the ultra-millionaire tax, which is not an unfamiliar concept in the Progressive Party and the Democratic Party. Moving on to Joe Biden, he has proposed to simplify the repayment process, narrow down the number of options that the borrowers have, offer some level of forgiveness. And the way that he proposes doing that is by focusing on income-driven repayment plans. So if you are earning less than $25,000 a year in income, you would not be required to make any payment on your student loan debts, and no interest would be accruing during that time. If you were making over $25,000 per year, you would be required to make a payment of 5% of your income over $25,000. And after 20 years of making those payments, your debt would be forgiven. He has also introduced the idea of a level of loan forgiveness for those in public service over 5 years, over the course of 5 years of repayment, which is a program that exists currently but is not necessarily the best in practice, and we'll get into that a little bit. He proposes to do this through a tax reform. He would cap the itemized deduction and eliminate the step-up in basis tax advantage currently offered to taxpayers. The one thing to point out about him is that while this seems to be his platform today, we shouldn't forget that back in 2005 he was a strong advocate for the legislation that actually made it very, very difficult for students post-grad students to discharge their debt in bankruptcy, discharge their student loan debt in bankruptcy. And again, we'll get into that in a little bit, but it's something that makes it incredibly challenging for students to be able to take advantage of the bankruptcy process when they're struggling with student loan debt. Kamala Harris is kind of an interesting one, and her proposal is probably the least thoughtful of them all. She proposed very simply $20,000 per year of forgiveness for individuals who were offered the Pell Grant going into school, and the Pell Grant focuses on underserved, low-income communities. So while I think the idea is certainly right, it's not very wide-reaching in terms of who would be able to take advantage of this benefit. And in addition, you not only have to be a Pell Grant recipient, but you also have to go on to start your own business. So when you think about those two factors put together, it's definitely a small pool of individuals who get to take advantage of that benefit. And then we have the most progressive of all the candidates, Bernie Sanders. His platform has always been more of a socialist than that of a Democrat, but we find him, running in the Democratic Party. His idea is to completely eliminate the student loan debt outstanding, the entire $1.6 trillion balance, and to then further make tuition at public colleges and community colleges free going forward. And he has a proposal to do that by taxing Wall Street is the way that he puts it. And the way it actually breaks down is he's proposing a 0.5% fee on any stock trade, a 0.1% fee on any bond trade, and a 0.005% fee on derivative trading. So it's kind of pulling from the individuals who have enough means to be investing money into the market. Ultimately they would get tasked with helping to alleviate the student loan burden and fund students to go to school for free going forward. So definitely a little bit more radical, but as I said, he is by far the most progressive of the candidates. And then we will talk about the Republicans, and we're going to focus on our current president because there haven't been too many other candidates that have been very vocal or have really even confirmed and hit the stage in terms of running against him for the Republican primary seat. So we're going to focus on him, and he does have a proposal. The top line of if you were to read it is that he wants to strike the balance between a student's needs and the taxpayer's interests. And I think what that means is attempting to find a way to alleviate the burden while maintaining the idea that the taxpayers shouldn't be unduly burdened because of their decisions to take out money to go to school. In doing so, part of his proposal is to eliminate the public service loan forgiveness program, reduce the number of income-driven repayment plans to just one plan, and to offer loan forgiveness, and to end the option to take advantage of subsidized loans, which is a part of the federal lending program in which your interest does not accrue while you're in school. So if I took out a loan my freshman year, I'm not going to be accruing interest on that all the way through the time that I graduate. And then I guess we can also look at what Betsy DeVos has done under his current administration as a way to determine what the future might look like. And this is where we'll jump back to the public service loan program that's currently in place. Essentially, individuals, in particular public service careers, were guaranteed in a sense that they would receive a level of loan forgiveness after, I believe it was 10 years of making their payments. What ended up happening is we came across that 10-year mark, and the first in line to receive that benefit would have been preschool teachers, public service lawyers, police, and firemen. And of those who actually came forward to take advantage of that benefit, only a little over 1% were actually granted the forgiveness that they were promised, which is very, very sad for what should have been a very good program. And in addition, she has always kind of maintained that the loan forgiveness process should be more difficult. She's been very vocal about trying to crack down on that process so that it's not being taken advantage of. So I think it's important we just go over some of the terms that you might hear as you're navigating this process and considering your options in terms of financing your school. And some of these we did already touch upon. But you have the option to look at federal loans, and you have as well the option to look at private loans. So federal are those that are issued by our government, and the private are going to be issued by businesses who are in the business of lending to you and ultimately making money off of the interest that you're paying. And we're going to kind of go into the severity of that interest and what these things can really cost you in a bit. So within the federal category, you then have the subsidized loans and the unsubsidized loans. And we touched upon this before. Subsidized means that you are not accruing interest during the time that you're in school. It doesn't begin until you graduate. Subsidized are also based on your financial need, and when you fill out your government form, they determine how much you need to go to school, and they will not lend above that. An unsubsidized loan will allow you to take out more than what your financial need assessment says that you need to go to school. Also, the other difference to note is that subsidized are only available to undergraduates, while the unsubsidized are available to either graduates or undergraduates. A fixed rate versus a variable rate loan is incredibly important. It is something that can either work to your favor or can go horribly wrong. So a fixed rate, as it sounds, the rate that you sign on will remain stagnant over the life of the loan. So if I sign up for a loan at 4.5%, I'm paying 4.5% until I either pay it off or I refinance at a different rate. A variable rate is typically dependent on the LIBOR or the going market rate. So if you sign up for a loan and you anticipate interest rates going down, it could, again, work out in your favor. The problem becomes when the interest rates start going up. Then you can end up in a situation where you're paying, if you have a student loan payment and the interest rates tick up, it could very well work out that you're not paying enough to cover your accrued interest. And that's where it becomes a particularly dangerous situation. You can have a cosigner when you sign up for a loan, and that's somebody who basically backs or guarantees the loan for you. So if you default on your payments, then your cosigner is going to start getting those phone calls from the debt collectors. Oftentimes, if you can get a cosigner and that individual has a better credit rate or a longer history of credit, then you as the borrower are offered a more favorable rate. So if you do have a family member, a parent, guardian, aunt, uncle, grandparent, somebody who's willing to do that for you, it could definitely work out in your advantage, but they have to understand that they're signing up, if you default on that loan, they're the ones that are going to start getting the phone calls. A Parent Plus loan is simply a loan that's owned by your parent, so they take out the debt on your behalf and they're financing your education. Budgeting and to pay as you go is what I would say to do if possible. The less that you have to take out in loans, the less interest you're paying, the better it works out for you in the long run. And finally, we have 529 savings plans. These are tax advantage plans that typically would be set up for you by your parents. The amounts contributed to the 529 plans are typically put into, say, an investment account. That investment account, the earnings on that investment account grow tax-free, and the withdrawals when they come out are not subject to taxes so long as they're used to pay for qualified education expenses, which would typically be tuition, room and board, and the sort. Okay, I'm going to kick it over to Zach now. We're going to talk about some of the legislative programs that might be available to you today.
Thanks, Melissa. So just going over what the programs that are not available to you from a legislation perspective, there is a couple of items to consider, first of which has to do with the taxes that we pay as citizens every year, what's out there for based on the federal program, and see if there's anything at the state level. So at least at the federal program, a lot of CPAs are familiar with this, and as a prospective student borrower, this will be something that is going to be very familiar to you as well. But there is one specific program where the IRS allows you to deduct a certain amount of interest that you pay in your loans in any given year. Specifically, that deduction amount is capped at $2,500. That being said, that amount is reduced, or the way we call it is phased out, based on the amount of income that you bring in any given year. So while that maximum amount is at $2,500, that amount gets phased out entirely if you make equal to or greater than $80,000 in any given year. So from a personal perspective, I would just say when I graduated college and I started my first job, I was trying to pay as much as I could to student loans, and given my student loan balance and my interest rate, I was able to hit that $2,500 interest limit and actually surpass it, actually a couple times over. But then when it came time to taking a look at my taxes and seeing whether or not I'd be able to reap the full benefit, I wasn't able to deduct the full amount of my interest that I paid, but rather I was only capped at that $2,500 limit, which was disappointing to say the least, but it is still a slight amount of relief in the grand scheme of things. Especially at the state level, currently there is no legislation for taxes or state-based taxes where we can deduct either student loan payments, student loan interest, or even just breaking out the principal component of that. I know based on a couple of bills that are passed, and I'll get into those in a little more detail now, there are steps that are being made to address that disparity, and hopefully over time there is a stronger push, both federal and state legislatures, to step up and be able to provide relief where feasible for these borrowers. So getting into the non-tax-based legislation, most of these items are state-based. The last bullet point I have there is talking about the federal loan forgiveness, and I'll get into that in more detail, but it just echoes what Melissa highlighted at a high level based on her explanation of Donald Trump's stance on student loans. But just getting started, the first two bullet points there, New Jersey Bill 3125 and also 3149 were both passed by Governor Murphy in April 2019, so a couple months ago, and they're very recent bills. The first one talks about borrowers specifically for New Jersey class loans, and that's a private loan provider. So specifically for New Jersey class borrowers, for those that run into financial hardships, there's recently passed legislation that offers relief where borrowers can reduce their monthly payment for a period of 2 years. This is offered through an existing program within New Jersey class known as the Repayment Assistance Program, or RAP for short. Specifically, the borrower is expected to pay 10% of their income above the federal mandated poverty level, which is around 150% of the poverty line at that point. For a cosigner for these New Jersey class loans, which over the course of the entire population of New Jersey class loans, approximately 90% of those loans do have cosigners included, so this is for a very large population. If those loans do have a cosigner, the cosigner also has to prove that they too are experiencing financial hardship. As Melissa mentioned before, they are also on the hook to repay that balance as well if the borrower isn't able to make those payments in order for them to qualify for this financial hardship program. Moving on, the next bill, S3149, also passed in April 2019, allows borrowers a one-time chance for these loans to actually bring a loan out of default by entering into a settlement agreement with the loan provider by making regular payments. So as I mentioned before in one of the previous slides, a loan that goes into default generally means that they haven't been able to make payments for approximately 360 days. Of course, that may differ depending on the loan provider, but I believe for New Jersey class, 360 days is the definition of the amount of time it takes for a loan to go into default. But in this case, in order to bring that loan out of the default status and have that loan in good standing, a borrower is required to make 9 out of 10 on-time monthly payments. It doesn't have to be consecutive months, but over a period of 10 months, if the borrower or the cosigner is able to make 9 out of those 10 monthly payments on time, that loan will then be brought out of default, which actually helps for a lot of things. First of all, you're making active payments on a loan and actually reducing that balance. Second of all, you're actually positively impacting your credit report, as any type of loan or anything that is due will actually negatively impact your credit report greatly, which could in turn impact making big purchases in the future, such as buying a home, buying a car, taking out additional loans, looking at credit cards, credit card shopping, or even opening up a bank account. Anything that pulls your credit report and that respective credit score will then see if your loan is in default. There's going to be a huge hit against your report in that manner. So it definitely helps out in that aspect. Moving on to the next bill, this was actually signed in August 2019, so this is fairly recent to when this presentation is being recorded. But for Senate Bill 1149, this bill particularly aims to crack down on predatory lending practices, and it strengthens the regulation over loan servicing companies, specifically within New Jersey. So all loan servicers, regardless of where they're domiciled, if they're doing business within the state of New Jersey, they're now required to be licensed with the New Jersey Department of Banking and Insurance, also known as NJCPA for short. It requires them to be licensed with this regulator and to operate within the state. The regulator, NJCPA, will actually ban companies from either not registering with the state, or if they're proven to engage in deceptive practices such as misrepresenting loan amounts or false or predatory selling practices and extending these loans, as well as overcharging for fees for borrowers in regards to those student loans. Additionally, there's also a newly created student loan ombudsman that will oversee any cases brought forth by borrowers or any complaints or questions they have about the loan servicing that they have with these companies that have to be registered with NJCPA. So moving on to the New Jersey STARS tuition reimbursement program, this too is specifically within the New Jersey class private loan program. But for this specific program, this allows for free tuition for students who wish to enroll in their local county college. So this actually helps in the sense that you are not taking out student loans while getting a college education. So based on a certain set of criteria, students within the top 15% of their class, either within their junior or senior year, could apply for this program. But specifically, if approved, New Jersey class will actually grant you up to 5 semesters, which is approximately 2.5 years, or 18 credit hours per semester of free county college classes. So depending on what county you live in, either Bergen County, Hudson County, Passaic County, you would enroll within your respective county college, and you would actually be able to take courses for free, which actually solves the problem of taking out student loans to get an education while also taking steps to get that education. So there's definitely a good level of initiative there by New Jersey class to offer that program. The next step is, the next item on the list here is the New Jersey class loan redemption program, where based on the type of industry that a person is working in outside of college, there are programs where your loan could actually be waived in partially or in full, depending on the amount that you have taken out within New Jersey class. So a couple of examples of industries are within the STEM industry, so any jobs that you have within science, technology, engineering, or mathematics within New Jersey, if you could apply, or if you have the ability to apply, you could have part or all of your loan waived. Another example is for prosecutors and public defenders within New Jersey. There's also physicians, dentists, nurse practitioners, certified nurse midwives, and physician assistants. It's also part of that loan redemption program. And then there's also nurses and primary care practitioners that are all wrapped up under this loan redemption program. So finally, getting to the last bullet point I have here, talks about the federal loan forgiveness. And Melissa talked about it briefly before regarding how one of the programs under this umbrella actually was in the news recently because based on the number of applicants that applied for loan forgiveness, they weren't able to get it based on the current administration's view as to how federal student loans should be handled. That being said, for that specific component, it is one component of a couple of other programs within this federal loan forgiveness umbrella, and I'll get into that into some more detail. So the first item that's under this federal loan forgiveness is based on industry. If you're a teacher, if you worked full-time for 5 years in a low-income elementary or high school, you would get up to approximately $17,500 in forgiven loans. The next item is what we talked about before, is if you were employed either by a government or a not-for-profit organization and you were able to prove that you were making 10 years worth of on-time monthly payments, so that's 120 consecutive months of on-time payments, and you were able to prove that you made those payments and you were able to prove that you worked for a government or not-for-profit agency in that time, then you would be entitled to have your loan forgiven. However, as Melissa said before, when the time came after the 10-year period since this program was launched in early 2008 for people to find out as to the status of their application, approximately only 1% of the applicants were approved for this program, and that definitely caused some outroar, and that's why it hit the news recently as definitely something of a negative result. A couple of other items under the federal loan forgiveness program is if you were a student within a school that is actually closing, if you're able to prove that that school is closing. Some big examples recently are ITT Tech and Corinthian School recently. If you're able to prove that similarly to those institutions you were a matriculated student and those institutions are closing, you are able to get your loans forgiven in full. There's additionally programs for those that have either permanent or total disability to have their loans forgiven. And then finally is the borrower defense to repayment. So similarly to the NJ Bill S1149 above, this one under the federal loan forgiveness program says that if you're able to prove that the institution itself engaged in either detrimental practices or misleading the borrower in question or other type of misconduct, if there is evidence to suggest that, then you can have your loan forgiven. So I would just say, as you're going through this program, this exercise of applying for schools, just be careful and read through all the brochures that you get, understand what you're signing at the bottom of each of the applications, and just be completely aware as to how this process is going. My number one tip is to read through everything that you sign. Even if it is fine print, it's still helpful to understand what you're getting yourself into, because for student loans, and Melissa can definitely agree here, but this is definitely both of us have big balances that we're in the process of paying off, and this is something that definitely affects people for multiple years after they graduate. So it's definitely an important item to take into consideration.
Absolutely. Yeah, I couldn't agree more, particularly in terms of reading these agreements that you're signing up for. I think it's very important to know what it is you're putting your name to and what it is you're committing yourself to. And just to put that in perspective, I know we kind of talked about this already. I mentioned, the $180,000 of debt that I walked out with. I'm 5 years into my career now, and I think I only just ticked under the $150,000 mark. The amount of accrued interest that I had to pay was just incredible, and it really hindered my ability to start paying down my principal, which is actually kind of what we're going to get into here in some of these next slides. So we want to really kind of emphasize what the loans are going to cost you. And the reason being because they can end up being wildly expensive with a moderate rate without any interest accrued during the course of your schooling. You could very well be looking at about 50% of the balance, the principal balance that you borrowed, being what you repay in interest. You certainly don't think about that when you're considering the cost of tuition and comparing school to school, doing the trade-off analysis. I might pay an extra $5,000 a semester to go to this school, but they have this great campus and coffee truck outside the gym that I love. But really, you need to think about what these things are going to cost you because, like I said, it can be incredibly expensive and overwhelming. So with that in mind, we're going to take a look here at an example. So we threw out a $100,000 number. We're going to say it's a subsidized loan, so there was no interest accrual while the student was in school. They graduated, and now they have a $100,000 principal balance. We have a 5.5% fixed interest rate, which might be a little bit high right now. I think I have mine range anywhere from 4.5 to 6.25, so kind of in par with what's offered at this point in time. And we're going to say a 15-year repayment period, which might be a little bit aggressive. You can extend your borrowing up to 25 years as a student loan borrower. We're going to say 15 just for the argument's sake, but know that the longer you drag out your loan, you will likely incur a higher interest rate and you will be paying more at the bottom line. So there's our inputs there. And what we've done here is we've put together an amortization schedule. An amortization schedule is a great tool so that you can understand exactly the cost of your loan as well as the timing in terms of the allocation between principal and interest. And you'll notice that as we move through the periods here from 1 to 23, over time, the amount that's being applied towards principal is increasing. The amount that's being applied towards interest is decreasing. And the reason for that is because we have a fixed payment here of $817 and some change. So as your principal balance goes down, your interest expense for each period becomes slightly smaller. Therefore, the difference, which is the amount that's applied to your principal, gradually increases, which is good for you because obviously you want every dollar that you can applied towards your principal balance. That's what allows you to kind of skirt the interest payment. So with that in mind, if we take a look, this is periods 1 through 23, but as we said, this is a 15-year loan, so we actually have a 180-period payback period, and that would be in months. So as we get towards the bottom of our amortization schedule, we've been paying off our loan for 14.5 years, we're getting towards the end of it, we'll see that by period 180, this borrower has paid $47,000 and some change in interest. Again, you borrowed $100,000, you paid $47,000, that is a 47% borrowing cost. Definitely astronomical and should absolutely be considered when you're signing up for your loans. Something to consider, one of the tricks that Zach and I have learned as we've gone through this process ourselves is that one of the ways you can attempt to relieve yourself of both the amount of time that you have to make your payments as well as the interest that you're paying on your loans is to make a prepayment towards what will ultimately be applied towards your principal balance. So if in this scenario I had a monthly payment of $817, and we're going to throw out the example of the individual had an extra $100 to throw away on their loans every single month. And this is where the decision-making process becomes particularly important, because you as a postgraduate might want that $100 to go out at night, go to the bars with your friends. But if you can figure out a budget for yourself that works and you are able to allocate a little bit extra towards your loans, we're going to see in a moment that will have a pretty substantial impact on what this ends up costing you. So same scenario, all factors are exactly the same, except this time we are making an extra $100 payment a month. So again, instead of the $817, we're paying $917 in our total payment. What you'll notice is that we come to the end of the life of this loan, despite being on a 180-period payback period, we actually complete and we make our last payment at period 152, which is pretty substantial in terms of the amount of time that you shave off having to pay it back. We're over 2 years have been shaved off of the life of that loan. Additionally, because you're paying that extra payment and it's being applied towards your principal balance, the amount of interest that's accruing every month is smaller because your principal balance is smaller by $100 every month. So in this particular example, we come up with a total interest expense over the life of the loan of almost $39,000 compared to the $47,000 in the first example. It's about an $8,000 difference, which is huge. That is the cost of a car. So definitely something that if you have the means and you can create the effective budget for yourself, definitely consider making that extra payment. The one thing that I will throw out there, and again, this goes back to what Zach was saying, that you really need to understand what it is you're signing up for when you sign your name on the dotted line. If your loan agreement has a provision in it that calls for a prepayment penalty in the event you decide to make an additional payment on your loan, that becomes a big problem for you because the amount that you're paying is now not being applied in total towards your principal, but only a portion of it is applied towards your principal, and dependent on what the loan agreement calls for, the rest of it is going towards the prepayment penalty, which is just money in the lender's pocket. So at that point in time, if there is a pre-penalty payment provision in your loan, you really kind of have to run the cost-benefit analysis because you're paying extra money to them that they wouldn't have otherwise earned, and you're not having that effect that you would hope for in doing this exercise, which is to pay down your principal to have less of an interest. So it really just kind of cancels itself out there. The other thing that you can consider as an option, and we kind of touched on this in the beginning, is that if you can refinance and take advantage of a lower rate, you should certainly do the analysis in order to figure out how much you're going to save yourself. I think it becomes a little challenging because when you look at your refinancing options, again, you'll be throwing out fixed options and you'll be throwing out variable options. The variable options are typically lower, and the interest rates are typically lower. And the reason is because the lenders understand that there's a risk, and there's a calculation that goes into those rates that they're offering you. And they understand that more likely than not, over the life of this loan, they are at some point in time going to end up winning on the deal that they struck with you. In other words, the rates will go up and you will be paying more in interest than you had originally signed on for. Now, on the flip side, if the interest rates are dropping, again, you can refinance and hopefully get yourself into a more favorable position by taking advantage of a lower rate loan. In this example, we look at the same criteria as the beginning, but after 2 years of borrowing, the borrower is able to refinance and attain an annual rate of 4.5%. Now, because you're refinancing and you're signing on to a new loan, understand that it's a new loan, therefore your repayment period starts all over again. So if you had a 25-year loan and you refinanced for another 25-year loan, the 2 years that you already paid back are essentially, they're not lost in the sense that you didn't pay down your principal, but you're restarting the time period. So now you're back at, day one of the loan. So definitely something to consider. You're not going to shave off time. In fact, you're likely going to add time onto your repayment schedule. But the point that's worth noting is that in this example, the 1 percentage point that we reduced our loan terms by yields a total monthly payment of $771 rather than the $817 we saw in the first example. And when we consider the interest over the life of that loan, and this would be the loan in its totality, so the first 2 years plus the new loan period, we are looking at $7,200 less interest being paid than would have been if we stuck to the original schedule without refinancing. So again, pretty substantial in terms of the dollars that you're saving yourself over the life of the loan. Also, this amortization schedule can easily be created in Excel. If you are struggling to create that on your own, Zach and I have created a template, and it is available. We'll make it available through the NJCPA. So reach out to the organizers in order to attain that document if it would be helpful to you. We'd be happy to provide it.
So I'll take it back over from here and just talking about how student loan debt can affect your financial future. So if I were to ask my 18-year-old self right now how, or at least expecting or anticipating what life would be like the first day after graduation, I would tell you I would have no clue, because 18-year-old me, as he was finishing up applying for schools, had no clue what he wanted to do with his life. I didn't think that I was going to be a CPA by any means. I wasn't sure what classes I was going to take. There was a lot of uncertainty, but in terms of trying to put yourself in the best position after graduation, it's still the best idea to try and look ahead and see how you could change things now to make future you in a better situation. So there's definitely a couple considerations specifically in regards to student loans that could affect your financial future, and we have a couple of key items to consider up on this slide. So the first item is credit score considerations. So everybody actually has a credit history and a credit score attached to that credit history. Whether or not there's a lot of activity for someone's credit report that impacts their credit score is a different discussion altogether. But generally, people that are younger and may or may not have a bank account or a credit card associated with them on file may not have as established of a credit score as those that have graduated 5-10 years ago, or may have a family with kids, or own a home, or own a car, or other examples like that. So in regards to applying for student loans, that's one thing to consider, because the lower your credit score is, the harder it is for a lending institution to actually offer you money at a low interest rate. So while they may offer you the money that you need to get your education, you're able to take out that student loan, your interest rate may be very high. To take, for example, 7-8%, possibly 10%, and that's just talking at the fixed rate. So fast forward to graduation, while student loans are on your credit report, the best thing that you can do right now is to make payments on time, if not accelerate those payments, to get those balances off your credit report and actually have yourself less burdened by debt. Another consideration to have is future borrowing capability. So while other lenders are able to see that you have student loan debt right now based on your income after graduation, they may or may not be willing to extend you additional money for whatever it is that you're applying for, either whether or not it's applying to buy a new home, if it's extending money to get a new car, either a personal loan out for one reason or another. The burden of student loans definitely plays a role into that in terms of how you're able to manage your day-to-day finances.
And the one thing I would just chime in there, kind of jumping back to both of those points, is as a borrower, one of the key considerations of your credit score is your debt-to-income ratio. So when you graduate with likely a relatively low salary and an astronomical amount of debt, like Zach and myself did, it definitely has an impact on your borrowing capability because that ratio is so out of whack from what a lender would like to see.
That's very true. Thanks, Melissa. So moving on, the next bullet point we have here is deferment. So deferment essentially means that if you are actively paying your student loans and making on-time payments, if you apply for this program, depending on the lender that you're working with, you may be able to pause making those one-time payments. Each lending institution is different in their own respect as to whether or not interest will actually accrue in that deferment period. So like we said before, it's very important to read the agreement that's there, understand if there are any prepayment penalties, as well as any implications with deferment. If you project that you're unable to make payments either due to changing jobs or a change in income in some aspect, and you're considering deferment, that's just one thing that may be a major hiccup as things may play out down the road, because if you do happen to get accepted for deferment, however your interest keeps accruing, you may find yourself paying a greater balance once you start making active payments again and you move that loan out of deferment. So that's something to consider. All right, so the next point I want to talk about is, I'm actually going to include the next two bullet points together when discussing this topic. So the impact of default and bankruptcy and how student loan debt plays a role. So if you're unable to make your payments on time, whether or not it's a period of 9 months or a period of a year, there's a chance that your loan can go into default. And there are a couple of practices that lenders could take in order to try and get those funds back. And the same thing could be said about whether or not you have to go through bankruptcy proceedings. But one major item or one major practice that lenders like to do in terms of trying to get their money back, or at least guaranteeing that they're getting their money back, is an act known as wage garnishment. So depending on the type of job that you have, if lenders see that you're struggling making payments, one thing that they can consider doing is actually taking a portion of your paycheck out and putting that directly towards student loans and not giving you the decision to actually pay those funds back yourself. So it's actually the lender creating their own budget and forcing that onto you as the borrower to say, this is what I think you're able to live off of, and the rest is going to go to your student loans. And if you felt before that you were in a pinch financially, the act of wage garnishment and the result of that is actually going to be a lot worse if you were to go through that route. So when possible, try and plan ahead and see whether or not, if by changing jobs, this is something that could impact you in the future, or if you sense that your income stream is not guaranteed over a consistent period of time. In regards to bankruptcy and how student loan debt impacts you, I would just say, as Melissa mentioned, in terms of speaking about Joe Biden before and the political candidates, for the most part, student loan debt is very hard to get discharged in bankruptcy proceedings. It's possible, however, you have to prove that there's a couple of criteria that you have to meet, but you have to prove that you're physically unable to make those payments on a monthly basis. And in order to prove that and to have that evidence, you actually have to go through the process of hiring an advisor and hiring an accountant to actually dig through your documents and being able to present that to the bankruptcy judge in order to prove that undue hardship, which is ironic enough because you actually have to pay that professional to do that research for you. So if you're going through bankruptcy proceedings, that means you can't afford to make your payments normally, but then you actually have to shell out more money to prove that you can't make those payments. So you fall into a very, very tough trap to get out of, and I would say it's almost a desperation move if it's all or nothing. But most of the time, it's very hard to prove that, and if you do have student loans and you are going through bankruptcy, most of the time, those student loans will not be dischargeable. And once those bankruptcy proceedings actually finish, you will still have that student loan responsibility, and that will stay with you once you finish up bankruptcy and you start your new history with your new credit report. In terms of undue hardship, similarly to the bankruptcy item, it's just a matter of proving in the future that you're unable to make your payments. But similarly to the bankruptcy item, it's just there's a set of criteria or a test that has to be done in order to prove that. It's three main criteria. So you have to prove that currently your standard of living or your state of living is at the bare bones, the least possible terms. The effort for the debt in which you're trying to pay is still present. So it's not like you're missing payments on purpose, but based on the budget that you set, whether or not it's including the rent, your living arrangements, any other debts that you have, as well as incorporating student loans. If paying back of student loans is the one main item, I think that definitely helps and is one of the criteria. So the third criteria that has to be considered in terms of undue hardship is proving whether or not this hardship in terms of repaying back the loan is a temporary or has a long-term impact. So if you're able to say that because of the level of income that you had, which has been a steady stream over some time, and the budget that you set for yourself and have able to prove to the lenders has been the same for a certain amount of time, if this is a long-term struggle that you have, as long as you're able to prove that, then the lender will be able to say that this is a long-term undue hardship. And at that point, there could be steps made to help alleviate the burden of that loan.
And just the one other thing to know as it pertains to bankruptcy, you have to remember that on the other side of the coin, you're trying to get relief for yourself. There's a lender who stands to make a lot of money who would not be entirely thrilled with the bankruptcy court ruling to discharge your debt due to undue hardship. So you can trust and believe that these companies who have a lot more money to spend on legal fees than you do will be knocking at the court's door trying to ensure that you're not getting that debt discharged.
So moving on to the last section, so as a prospective college student, what can you do right now? What are the key things that you can do to put yourself in a better situation while getting a high-quality college education and setting yourself up for finding either that dream job or pursuing that dream career in the long term? We listed a couple of bullet points here, some recommendations just as a high level of things to consider. So first of all, as Melissa and I stated throughout this presentation, one item that I think is definitely crucial for everyone to do, whether or not you're a college student or a graduate, is to understand what your budget is, whether or not that's at a monthly or weekly basis, just understanding what money is coming in and what you're expecting to go out, and whether or not you're hitting those marks respectively as time goes on is definitely something that's crucial to understand how you could better navigate the requirements and the responsibilities that you have on a day-to-day basis. So one other webinar we're trying to do in the future through the NJCPA is actually talking about the fundamentals of setting a budget and things to consider. So there may be a part two. Stay tuned for that as the NJCPA will come out with more information on that very soon. Another couple items to consider is to save wherever you can. Keeping that bank account and that the piggy bank full as often as you can, overflowing if possible, and definitely trying to keep that money for an emergency savings. There are definitely some mobile-friendly apps such as Acorns and Stash that can help you save as best as you can and try and identify actually which expenses may be considered to be frivolous and what you can cut down on in order to save as much as you can, and something that could be used in the future to offset those student loans should you decide to go through that route. Another item to consider is if you do already have money in a bank, try and identify a high-yield savings account for you to get the most out of your money. If it's just sitting in a bank account day after day and you're not really using it, have that money make some money on itself. So while we understand that interest rates for these savings accounts have been dropping over the past couple of months, there are some web-based bank accounts out there. For instance, Goldman Sachs Marcus bank account. There's also Ally, Synchrony Bank, and American Express also has savings accounts offered through those institutions that offer greater than 1.5% in savings, and that any dollar that you have saved definitely helps in the long term. Another item that we have here in the same bullet is to get a secured credit card through a bank. And personally speaking, this is something that I did to actually help create a solid credit rating and increase my credit score. Essentially what this is if you set aside some money and you give it to a bank and say, hey, I want to set aside $1,000, let's say, and I want to open up a credit card, the bank will take that money and use that as your line of credit. And what you would do then is you have a credit card with $1,000 as the example of your line of credit, and you're able to use that credit card at your leisure. However, your limit on that credit card is $1,000, and you're responsible for making on-time payments to make sure that you pay off that balance or make a good effort to pay off a portion of that balance every month. What that does is that it proves to the bank that you're able to have a line of credit which over time will actually raise your credit score. And then either in a period of 12 or 24 months, you will actually get that money back, and then you will actually get a unsecured credit card, which is just a normal line of credit with the bank to say, this is your credit card. We are giving you $1,000 or a $2,500 limit that you're able to spend at your leisure. But I think it's definitely a good idea for people to consider if they do have money laying around that they're not using. It's just making an effort to establish your credit rating and solidify your credit report. The next bullet point that we have here is considering as many scholarships as you can. Apply to all of the scholarships. So just putting in a personal plug, the NJCPA does have a scholarship that they award to a select number of high school and college students for those that wish to pursue a major in accountancy. So there are definitely there are a lot of scholarships to consider, at least from the NJCPA side. You can take a look at the NJCPA website and get more information there. Another website to take a look at and see which scholarships would be worth of applying is through collegescholarships.org. And this is open for anybody to take a look at. They list scholarships from all across the country from all different types, whether or not it's by industry, if it's something that you enjoy doing on the side. I think there are knitting scholarships. There's definitely a wide variety of things to consider. So I would definitely recommend going there because any dollar that you get in a scholarship is a dollar that you don't have to take out in a student loan. And it's something that you don't have to worry about paying back in the long term. So do what you can and max out as many scholarships as you can if possible. The next item, as we mentioned before, just being one with your credit report, understanding what's on there, understanding the key drivers as to how your credit score gets derived, things that are helping your credit score or hurting your credit score. It also, one other key item for your credit report to consider is that in this day and age, there's a lot of talk of identity theft and people stealing one's identity to either profit or to harm a specific person. And one key tell to see whether or not you're a victim of identity theft is to see whether or not your credit report has information on there that you didn't agree to. So for example, if somebody took your social security number and purchased a car and created a line of credit to buy a car, yet you did not buy a car, it would come up on your credit report as that car dealership would send an inquiry for your credit at that point. I would just say do what you can to get a summary credit report to see what's there, and just make sure that you're comfortable with all the information and all the history that's presented on there. And if not, either one of the 3 credit bureaus are able to answer any questions that you have. Wrapping things up, the next 2 bullet points is finding a source of income if time allows. Understand that high school students and college students may be very busy either through their studies or extracurricular activities, but if possible, we're now in the day and age of doing side jobs, and the gig economy is definitely alive and well. So if possible, whether or not it's working as a delivery driver, or if there's a talent that you're good at, I would definitely recommend considering whether or not you're able to turn that into a money-making business. And then finally, being thrifty. As we talked about, trying to save where you can, especially now for those that are younger and just starting out, either going through college or having just recently graduated. If you're thrifty now and you're able to save where you can and just be smart with what you're budgeting and what you're looking into, if the sacrifices you make now definitely pay off in the future and definitely put you in a better place. So whether or not it's making a decision of going out with your friends or staying in and saving $100 or so in a bar fee or bar tab, then it might be an easy decision to make, because it definitely helps out in the long term.
That's a big bar tab, Zach. So we threw a couple resources up here for you. Definitely feel free to check them out. There's some great information on the internet. There's a lot of companies and organizations that put this stuff out there, attempting to assist people in doing exactly what we're doing, which is helping them understand their options and what exactly is out there for them. And the one thing I would throw out there is perhaps one of the most local, accessible resources of them all would be the NJCPA. Zach and myself are members of the Emerging Leaders Council, as he said in the beginning of the presentation, and we have a student loan subcommittee which focuses on providing content like this and other written content that we can provide to students that might assist in the process. So definitely do not hesitate to reach out if you have questions or concerns about your own situations. And yeah, we thank you so much for your time and your attention, and hopefully you found this helpful.
Take care, everybody.